In order to get ready to raise capital for launching your startup into commercial operations, you need to prepare a budget for the first 2 to 3 years. Since your startup doesn't have any past business history to base a budget on, you need to rely on estimates and assumptions. Let us look at how such a budget can be made from scratch. To get started, divide your basic budget estimates and assumptions into 6 sections. 1. Initial investment. 2. Sales forecast. 3. Variable cost estimates. 4. Fixed cost estimates. 5. Working capital assumptions. And 6. Financing needs. Let us look closer at your working capital. This is the amount of money you need to run the business on a day-to-day basis. The demand for working capital changes with the volume of your business and the decisions you make about payment terms and how much you keep on stock. In order to estimate how much working capital you need, consider a few things. For how many days of operation do you need raw material on stock? For how many days of operation do you need finished goods on stock? How many days after delivery of materials can you owe your suppliers before you have to pay them? How many days credit do you give your customers? Also, how much do you need to pay in advance to your suppliers, and how much do your customers pay you in advance? Having covered the above 5 sections, you will be ready to move to the 6th section of your budget, namely determining how much money you need to finance your investment and working capital. You can invest your own money and raise capital from investors. That's called equity. You may also be able to obtain loans. Based on the 6 basic sections of your budget, you can now generate 3 types of finance projections. 1. Profit and loss projections. 2. Balance sheet projections. 3. Cash flow projections. Profit and loss projections are presented in a summary statement that lists expected revenues and costs to give a transparent and clear representation of financial performance for a particular period, usually a year. Investors will be interested in your revenue and profit forecasts. The balance sheet projections show your business's health at a certain point in time, typically at the end of the year. What your company owns. These are the assets. And what it owes. These are the liabilities and the shareholders' equity. The cash flow projections allow investors to understand where cash is coming from and where it is going to be spent. They are very useful when determining how much money is needed to finance the investment and operations of the company. If your cash flow budget shows that cash at the end of any period is negative or too low, then you need to go back to the financing section and increase the capital or add more loans. You may have to iterate a few times until you find the correct amount. There are many free tutorials available online showing you how to build a profit and loss statement, a balance sheet, and a cash flow statement. If you want to avoid the hassles of building up your own budget in a spreadsheet, you may take advantage of a budgeting or business planning software program. You can purchase these online. Your budget is the backbone of your business plan, and therefore it is also an important tool in attracting investment into your startup.